Everyone wants to live an inspired life, yet so many people search for happiness following the footsteps of peers and taking advice from people who have different values and outcomes to which they're searching. There are people born into wealth, graduated from the best universities in the world, and there are people who have none of that and yet are living extraordinary lives full of fulfillment and reward. The purpose of this podcast is to share insights and strategies that allow you to question the status quo and think freely, so you can design your life and be who you want to be. We get one life. Time is our most valuable asset. I believe that when we're free and able to focus on meaningful work, we become better human beings. This is Always Free, and I'm your host, Jason Graystone.
Welcome to the leading podcast for financial empowerment and wealth creation. Subscribe to this podcast so you don't miss an episode. You can connect with Jason on social media and subscribe to the Jason Graystone YouTube channel for weekly videos. Don't forget to also subscribe to the weekly newsletter to receive frequent educational content and action steps to help you design your life so you can be who you want to be. For news on all future events and updates, go to jasongraystone.com.
Well, welcome back to the podcast, guys. I hope you're all doing well. If this is the first time you're listening, welcome. You're in a good place. This is the number one podcast for financial empowerment and wealth creation. And if you're, well, as always, if this is the first time you've listened, then go back to episode 1 after you've listened to this episode, or even stop now and go back to episode 1. Save it to your favorites. Make sure that you listen to all of the episodes to date. This is episode 64, I believe. And today I'm going to be talking about investments a bit more and kind of the way that people go about investing, the kind of the wrong way around doing it, and how I'm going to give you a kind of analogy here on how I want you to think about investing. So if it's echoey here, by the way, I'm out in Mallorca in a big villa here, so it's kind of echoey because we've got all the tiled floors, and hopefully it doesn't come out too much, but if it's echoing, you'll think I'm sitting in a toilet. I'm actually in a villa. So what I want to talk about really is people who try their hand at investments when they feel like they're up against time. Okay, and what you can do, the way that you should think about investments. Because what most people do is they try to, you've heard me talk many times before about building a sustainable investment system, a liquidity system, a system that will be sustainable, that will stand the test of time. And I'm always thinking about longevity, and I'm thinking about exponential growth, and I'm thinking about legacy. And what people tend to do is they tend to get to this point in their life where they try and think of how's the quickest way that I can earn lots of money. And of course, with lots of volatility and lots of potential reward comes high risk, and there's a downside, right? It's a double-edged sword. And what you don't want to do is get to that point in life and have your emotions driving your investment decisions, which is then going to throw you into that double-edged sword. And you're not in the best frame of mind to even be qualified to be making those type of speculations or investments, but 2, you're not going to keep what you earn. And if you don't believe me, think about this. If you've got to that point, the reason that you haven't built as much wealth as you like is because you haven't valued the money that you've earned as much as you think that you have, okay? And whether you not like to believe it or not, the proof is in the pudding. So, it's just a bit like a relationship. People who value relationships, okay, they work hard at them and they build equity in them, and they embrace the both support and challenge in a relationship, and they go through good times and bad times, and they build this equity, and as a result, their relationship appreciates. However, if people don't appreciate relationships, they'll end up getting rid of them or doing something bad or cheating on them or whatever and starting all over again, and it goes on and on and on. Now, with your money, think about this. If you was to go and add up everything that you'd earned to date, because I get a lot of people saying, I feel like I should have had more money by now or more wealth by now. I'm getting into my 30s, 40s, and I've earned a lot of money in my lifetime, but I don't seem to have as much as I think I should, or not enough to show for it compared to what I've earned over the years. And that's a great exercise to do, because if you do this exercise, it's going to, 1, show you how much you value money, really, in black and white, right? Black and white. And two, it's going to kind of shift your mind to thinking in terms of, right, actually, I do need to kind of shift my values on building wealth here. And the easy exercise to do is to literally add up everything that you've earned. I've done this before on the podcast, but add up everything you think you've earned over the years, and then add up what your net worth is. So what you've managed to keep. How much is everything that you own right now, including all the cash in your bank, equity in your home, whatever you might want to add to that. How much is that worth? And that will tell you, if you divide that by the amount you've earned in your life, it will give you a percentage. And if it's quite low, I mean, some people are negative, right? Some people owe money. They're actually negative, which means they've got rid of everything they've earned plus more, which is quite low, right? And and most people are in that. But I want you to understand that people spend a direct proportion of their income on what they value most. So if you don't value wealth building, I know I sound like a broken record, but if you don't value wealth building, your number will be quite low there. And then what people do is they kind of tend to get to a point in their life where they try and get the quickest returns possible. Okay, quickest returns possible in the shortest amount of time, and they haven't built a pyramid. They haven't built a pyramid the right way up. They build an upside down pyramid, which of course topples over. So what I want you to do is to start thinking about your investments like a bed of nails, right? You might have seen the magicians or Houdini or some of the famous magicians in the world lay on a bed of nails, right? And you think, well, how doesn't that hurt? Most people treat their investments like one nail. So they'll go and make an investment. They'll pick one stock or one, commodity, one, future, one, they might pick a money market. They might pick the Forex market. They might take a punt on a startup, an IPO, ICO, and think of that as one nail. And when you're watching that one company, let's just say it's one company, and you're just watching that one company and all your money is in that one nail, that is going to be a pain in your butt. Right? You try and sit on that nail, it's going to hurt. It's going to, when all the money, if that market takes a dip, if that company takes a dip, if sales aren't going too well and the stock drops, that could be a 1 year, 2 year period. It could even go bankrupt, and that's going to hurt. Okay? Whereas if you add another nail to that that's selling something different and selling it maybe in a different sector, or you add 5 or 10 of those nails, even in the same sector, that's going to hurt a lot less. And the more nails that you add and the more diversified those nails are, okay, so imagine all of the technology nails being in one row, and you start to add another row that is pharmaceuticals, and another row that is cleaning products, and another row that is education, and another row that's technology, right? And you keep going and going and going. And every row is a sector, well, all of a sudden you're producing a bed of nails. And when you lay on that bed of nails, it doesn't hurt anymore. You can lay down and one of them might go blunt and you won't notice. One of them might go really, really sharp and you won't notice, because you're laying, your weight is distributed across the entire bed of nails. And that's what I want you to think about building, okay? I want you to think about a bed of nails when building these investment portfolios. Very famously, you've probably heard of Ray Dalio. Ray Dalio, who works for Bridgewater Associates. He's one of the best, if not the best, investor in the whole world. His company is extremely successful, and he's written a book called Principles, which is a very, very good book. I highly recommend the book. Anyway, back in the 90s, they kind of officially announced this all-weather portfolio. And essentially what that is a bed of nails. It's split up into bonds, commodities, large cap equities, and long-term bonds. And that whole portfolio put together is an all-weather portfolio, so that if the markets dip or the sector dips or a certain company takes a hit or there's a recession, it's not as painful. Okay. In fact, even in the last, in the global financial crash, when the global financial crash happened in 2008, 2009, even though the market dropped about 40% or just under 40%, this portfolio only dropped about 3.9%. And that was the biggest losing year. And that is, a 40% decline in the market. So other than that, it's had 30 to 40 profitable years, year on year. It's had like 5 or 6 drawdowns in the total history of the strategy. And that's what I'm talking about when I'm talking about bed of nails. I'm talking about building something that is sustainable. It grows a little bit slower, but you keep putting money into it and it will compound, and you'll benefit from that exponential growth. Now, if you are adding speculation to that, so if you're adding, you might be adding you're picking some stocks, you might be picking some individual stocks, you might be in the Forex market, you might be in the crypto market, you might be building up some speculation. And because you've got a buffer of cash in this kind of bed of nails, you might have the mindset and mentality to be able to push higher speculation, because you've got a higher probability of succeeding in those when you're trading money that you can afford to lose. And if you're doing well at that, what you're going to do is you're going to start to build this pyramid. So the base is the bed of nails, and then you're going to start to speculate. And when you start to speculate, typically the returns will be higher. So what you'll find is if you take a portion of your investment account, overall account, and you put it into speculation, that's going to grow a lot quicker than the bed of nails, which is growing nice and sustainably and steadily and almost, guaranteed growth, right? Like fixed income as opposed to growth income. And your speculation will start to exceed the returns of your passive investments, your bed of nails. So what you want to do then is do something what I call a rebalancing. And you can do this once or twice a year. I do it once personally now, although I did it twice this year because we were in a bit of a different situation. I moved some money around. But essentially, we want to keep it bottom heavy. We're building a pyramid. And if you want to keep the pyramid bottom heavy, that means that when the top part of the pyramid starts to outperform and kind of get better returns, or more returns, I should say, than the lower part of the pyramid, it's going to be a bit top heavy. So that's what we mean by rebalancing. You want to take the cash and rebalance it all out so that it remains bottom heavy all the time. And then the way that you do that is to kind of deploy the money evenly over a space of time into those passive investments for the remaining 6 months, say, so that you don't try and put all your money in one time, try and time the market. We don't want to be doing that either. So I kind of just wanted to go through that because I get a lot of messages about, I feel like I should have more money than I have right now. What's a good investment? What can I put my money in to get quick returns, better returns, higher returns? And my advice is always start building the pyramid bottom up, then earn your way to speculation. Earn your right to speculate. I can't stress that high enough. Now, the kind of caveat to that is if there are certain traders that are going all in on trading and they've got a large fund of capital, or they're going to manage money and they're going to actually do that as a business, then absolutely. But my advice is this. I've worked with thousands and thousands of traders, and a very, very, very small percentage of traders are actually able to do that successfully and sustainably. They end up usually too emotionally driven, too emotionally triggered. They can't manage money. Managing someone else's money is managing your own money is one thing. Managing someone else's money is a completely different ball game. And again, my advice is to have those buffers, have the bed of nails, so that when you get to the point when you're speculating and you're trading, you're trading money that just really isn't going to hurt. It really isn't going to make a difference to your bed of nails. So that's it for this. That's it for this episode, guys. I hope you enjoyed that. If you've got value, please share it around. It's probably a shorter episode this week because I'm on holiday. But I wanted to get this out to you, so I hope you enjoyed that. If you did, give us a little review on iTunes, and have a great rest of your day and weekend, and I'll see you next week.
news on all future events and updates, go to jasongraystone.com.